So is Fisher Investments worth it? Well, today we're taking a deep dive. Choosing the right financial advisor is a big decision, and it can impact your financial well-being for years to come. Two common options I see people considering are working with Fisher Investments or maybe an independent advisor. But first, full transparency. My perspective. Before diving in, I'm an independent advisor. Naturally, I have bias when comparing Fisher Investments to advisors like myself. If someone chooses to work with an independent advisor instead of Fisher, that could mean they end up working with me. So before the critique, I just want to acknowledge what they do well. Fisher Investments does put a lot of effort into investor education and building up understanding about market volatility and embracing the right mindset that can help clients avoid the common traps of market timing or poor emotional decision making, which can lead to poor investor results. I think this aspect of their approach is beneficial. Additionally, Fisher offers an equity focused strategy. I generally agree that stocks are the best for long-term capital growth. Fisher's philosophy leans aggressive, meaning clients may experience more volatility in their portfolio over time. And historically, that approach has yielded rewards to investors. So let's take a closer look at Fisher Investments. Fisher is a large, well-known investment management firm offering portfolio management, and their marketing emphasizes an active approach with a focus on long-term growth in their portfolio. Some of their strengths include an established reputation. Fisher has been around for a long time and has a well-defined investment philosophy, and they invest boatloads of money into marketing. It's been effective, reaching a wide audience and building a brand. They also claim to provide a full suite of services under one roof. Now their weaknesses. Fisher's fees are up to 1.5% on the first 500,000 and average about 1.25% overall. This is higher than industry averages of around 1 to 1.1%. So you should be ensuring you're getting above average value, not just investment management, but also tax planning, estate planning, retirement planning, strategy, benefits planning for employees or small business owners. There's also active management risks. Fisher markets itself as an expert stock picker, but their portfolios haven't always delivered strong results. Based on publicly available data and their 13F reports, they are currently heavily weighted to U.S. large cap stocks. A strategy that has worked well recently, but history shows this can backfire. For example, in 2000, tech stocks looked like a winning bet compared to anything else. But during the lost decade of the subsequent 10 years to 2010, portfolios overly concentrated in U.S. large caps and tech significantly underperformed those with international and small cap exposure that were more diversified and potentially looked less interesting during the roaring period of the late 1990s. There's also potential for less personalized service. Fisher has a high marketing spend. It means they need to bring in a lot of clients to break even and profit there. Their sales team is labeled as vice presidents, and they basically earn a commission every time they sign a new client. But after you join, you're not working with the same person. You may be handed off to an investment counselor who may be managing up to 200 plus clients. And many reports I've found suggest that there's a high turnover in this role, which can lead to pretty inconsistent service and a real lack of proactive planning and supportive relationship. There's also this sales-driven culture in Fisher Investments. Fisher uses fear-based marketing. The founder, Ken Fisher, famously even said, "I'd rather be dead than sell an annuity." Outright dismissing them creates bias and maybe even confusion. Fisher doesn't sell annuities, so they do have a conflict of interest. They make more money when you invest more with them, meaning any money that goes elsewhere, like with annuities, is money that they lose. If I were evaluating an advisor, I'd want someone who builds trust through education and transparency, not one that scares me into working with them. Another example of this is when Fisher says, We make money when you make money.
Different. How so? We're a fiduciary, obligated to act in our client's best interest. So we don't sell any commission-based products. Then how do you make money? We have a simple management fee, structured so we do better when our clients do.
They insinuate that all other advisors are getting commission and they have this beautiful fee-based compensation arrangement that only increases when your account increases. But this is just not an accurate picture at all. And it creates more confusion than real education and transparency. The fact of the matter is that the overwhelming majority of compensation in the advisory industry today is structured exactly the same as how Fisher is compensated. I've had clients think that these ads mean that Fisher is saying that they only get paid if clients' accounts go up and that they won't get paid at all if they don't get returns. This is patently false. And I'm not saying that Fisher says this in their ads, but their advertising is somewhat misleading and a little bit confusing and ambiguous as to what it actually means and what is true for investors that need to make a decision for who to work with. I'd also say that they have limited tax and estate planning. Fisher markets that they offer tax and estate planning services, but the actual support seems minimal. Tax planning is complex. It requires deep, personalized analysis, something that's very difficult for large firms to scale effectively. Reports I've found suggest that Fisher has CPA on staff, but offers high-level guidance rather than detailed, ongoing, and specific tax planning to each individual. Independent advisors who have expertise in this area can offer and provide a more proactive, hands-on approach, potentially saving clients thousands over the course of their retirement. So why would I consider working with an independent advisor? Independent advisors operate differently from large firms like Fisher. They tend to offer more client-centric, relationship-centric advice that is rooted in a deep understanding of the client's needs and their values. The strengths of an independent advisor relationship is the personalization. By working with an advisor, you're ensuring a better fit and a better ongoing relationship as opposed to maybe swapping out an investment counselor every so often. You're also going to get more in-depth tax and retirement planning. If the advisor has expertise in tax planning, you're going to get much deeper support than what a large firm can provide. Strategic planning can come in the form of retirement, income strategies, Roth conversions, charitable giving advice, and can lead to potentially a significant tax savings over time, meaning more money for you. And there's also less likely to be a high pressure sales environment. Advisors don't get paid commission usually, so they are looking for ongoing relationships as opposed to the vice presidents at Fisher, who may have more of an incentive to just get the transaction over with and move on. There are some downsides to maybe considering an independent advisor. It may take more work. You need to research the independent advisor and vet them for an experience level and qualifications, since they may not have the same brand recognition as Fisher. And there may be fee variability. Fees may depend on the level of service and expertise involved with that relationship and the level of needs that you may have as an individual. Some independent advisors may charge more and some may charge less. And so you may have to evaluate the quality of the services you're getting and the level of relationship and support involved. So how do you make the right choice? What's the right framework? Choosing between Fisher or maybe considering an independent advisor comes down to your personal preferences and financial needs. I would consider the complexity of your finances. Do you really need more detailed support from a tax standpoint? Do you have large retirement accounts that have significant tax implications that may apply to you? Or are you just looking for investment management? There's also risk tolerance. Are you comfortable with Fisher's aggressive stock-heavy approach, or do you prefer a more balanced strategy that may be more aggressive if you have an inclination towards that, but may have flexibility to do other things depending on what your needs are? There's also expectations. Do you value a high touch personalized service, or are you okay with a call center model? There's also the fees and the value. Can you justify Fisher's above industry average fee? And do you feel like they're going to provide above average value? Are you comfortable with the advisor that you work with? Are you willing to do the research and vet an independent advisor and potentially have a higher quality relationship and determine the right fit? So, in conclusion, there's a lot of factors to consider. Fisher positions itself as a superior alternative to the commission-based advisors. But in today's world, you really need to focus on not just the good guys versus the bad guys, as Fisher likes to paint it. It's what fits you best. And in my view, I think if you work with Fisher, you're probably going to get a reasonably sound investment approach, but you're probably going to be paying a lot for that and get limited attention on an ongoing basis. As people are approaching retirement and getting closer to retirement, they may want an advisor who's going to be proactive about what their needs are and help them think about these before they start needing to call for attention. This could include detailed support on tax planning, healthcare planning, long-term care planning, retirement income strategies. So consider your investment philosophy and see if your potential advisor aligns with that. Assess the level of personalization you feel like you need and evaluate the fees and whether or not you may be getting the value out of that relationship that you could be. At the end of the day, the right advisor is the one that prioritizes your financial well-being, not just their bottom line. And that could be Fisher, but it could also be an independent advisor. So if you found this video helpful, check out the video link in our description to learn more about our process. It's called Financial Strategies that can help you boost your bottom line nest egg by potentially $100,000 or more before retirement.